Ladies and gentlemen, it's a real pleasure. My city, a privilege, being surrounded by former colleagues, by friends, and indeed, as you rightly say, an opportunity to touch on something that is deeply close to my heart, which is this whole issue of contact risk and how it links to Prudential. By the way, you will note that my hat is here, my wallet is here, so they are not necessarily on the same place. The topic, let me be very candid, I was asked by Connor and Jonathan to present, is precisely the one that I would have chosen with a blank sheet to say, okay, we want you to come here, you can choose whatever topic you want. Not only that, even the title is the one that I probably had drafted, not with such a good and eloquent English, but it's about conduct, it's about culture, it's about corporate governance, and it talks about setting and finding the linkages between conduct and Prudential. Having been nearly 20 years a regulator, there was something I was doing fundamentally wrong for many years, which is had a silo approach to Prudential issues, only Prudential, to conduct issues, to financial stability issues, not trying to be able to set the links. And let's be very honest, that doesn't work. So I definitely welcome and encourage the fact that in IAIS they are much smarter than someone like myself was in the past. The purpose of today is very simple. We want to explore. We want to inform you of what IAIS is doing. My small children would use the word spoiler, so I hope we get a number of those spoilers today. We want to share some views and thoughts, and last but not least, we want to shake some of your beliefs. I'm doing some trainings these days on conduct and culture for boards of insurance companies, and I always tell them that my one and only objective is, and that is kind of the key success indicator, that once we have terminated this 1 hour, we are in a position, ladies and gentlemen, you are in a position to challenge things that you have always taken for granted. If we succeed on that, we will have fulfilled our objective, and you will go back home not only with nice memories of Buenos Aires, but also with some food for thought beyond the nice steaks, by the way. So talking about, let's say, a small introduction on the topic, I've seen that for the last 2 days, there was always a member of the team, a supervisor presenting the issue. But from a consultant to ask a supervisor to present, I think it was a little bit inappropriate. So it's time for me to step in. And I'm going to step in a manner that I would say hopefully fulfills expectations of all of you in terms of myself, as you know, bringing my wife into the equation, telling you a little bit of a couple of stories, and why not reflecting on how an old-fashioned person approaches today's life and reality. Before getting married, and this is something I've shared with some of you, my wife only said, there is one thing that matters. I want you to be there when it really matters. I want you to be there for me when it really matters. This is great definition of insurance business. And let me grab quickly 2 examples. Fukushima, Japan. Insurance stepped in. Perception of the society, of the Japanese people, was one of gratitude because insurance delivered at a time of need. Let me go with a second one. A young guy, 18-year-old, wants to buy a 1,000 euro iPhone. He doesn't have the 1,000, so he gets a credit protection insurance. Let's say that the poor guy is one of the 0.0003% that may die on that year. Will the 1,000 euros insurance coverage repay the family the grief that they are going to be going through? In both cases, they are fulfilling their promises. Are we talking about the same issue? So that's the first element. And by the way, and this is something important, it will allow us to put things into context and to put into value what is the role of insurance. I have shared with IAIS audience when I used to have the gray supervisory hat, number of stories normally linked to my children. But my children are getting older, so if I could bring Cinderella or Snow White, probably that wouldn't fit. That means that as my children are getting older, stories have to adapt. Today I'm going to tell you a story about tobacco. 15, 20 years ago, tobacco companies were selling cigarettes with a lot of addictive elements embedded. Court cases and regulation pushed them to change. And they changed in Europe and in the US, where regulation was pushing. They made a massive communication campaign. We care about the health of our clients. That's why we're changing. But at the same time that they were doing that, they kept selling those very same cigarettes here in Latin America, in Asia, in Russia, in Africa, and so on and so forth. So much about culture, so much about, let's say, walking our talk. The final point I wanted to make, and I think this is going to be the link for what we are going to be discussing, is as an old-fashioned guy in a time of technology, I still love letters. And there is a letter that everybody has been talking about in a different context, which is this letter of Larry Fink of 2018 that people links to sustainability. Let me take two very small paragraphs from there. The first one says, companies must benefit all of their stakeholders, including shareholders, employees, customers, and the communities in which they operate. The second paragraph I want to bring is, without a sense of purpose, no company can achieve its full potential. It will succumb to short-term pressures. So what do we take from here? We talk about shareholders. This is a business. And sometimes we tend to forget that in a business, it is legitimate to make money. The second point is we're talking about employees. And you know what? Not only they work in corporations, they are persons and individuals. So whatever is linked to their own values and whatever is linked to the values and the corporate culture will matter in the same way that corporate governance will matter. We are talking about customers. Should we see them as clients? Maybe, Birny, that's an issue that you will bring. I think that's an interesting question, but it links to policyholder protection. And last but not least, we have used the word sense of purpose, which is the perfect link to culture. So in order to deliver this, we have put 3 blocks that perfectly fit with the skills and competences of our very skilled and competent panel of today. We're going to be talking about governance and culture as a link between Prudential and conduct. We are going to be talking about the business reality. And last but not least, definitely not least, we are going to be talking about policyholder protection. So whom have we got here for that? To my left, we have Anna Jernova, who happens to be chairing the IAIS working group on governance. Seems fit for purpose. As I said, we expect spoilers. In the middle, we have Julien Reid from the IFM, the IMF, Autoritédes Financiers, in Quebec, who in his past life used to be the chair of the conduct working group. And between you and I, maybe you didn't know, the two of them are working together now. So they may have some creative ideas to surprise you all in here. And last but not least, we have Bernbaum. I'm not able to pronounce your family name, but having been living 9 years in Germany, I can tell you that it has something to do with a pear tree, right? Birny is pear in German, Baum is tree. So I'm not going to call you consumer champion because I heard you yesterday say there's only 2 consumer representatives, so it's probably easy to become the champion 1 out of 2. But it's also fair to say that you work on something called the Center for Economic Justice. I would love that after the work of IAIS, you are able to change the name and talk not about economic justice, but about economic common sense. Because in any business, a happy client is a client that delivers for the business. With this, ladies and gentlemen, let us start with the first of these 3 blocks, the block that has to do with how are we going to be linking the governance part of this whole equation. We were talking about setting links between conduct and Prudential. Many of us have spent many years on ICS, on Solvency II, on RBC, and it was clear that corporate governance was one of the founding rocks of that. Anna, I jump into you. How are you going to be reflecting that element and that reality in the world of conduct?
Thank you, Carlos. And I would like to, I guess, focus just the initial element on the full title of the panel, which, as Carlos alluded to, is Culture, Conduct and Governance and Linking Prudential and Conduct Risks. And it's true that conduct and prudential issues bring their own challenges and risks, and for that that's one of the reasons why in the UK, where I sort of work in, we have a Twin Peaks approach to supervision. But at the same time, there are many examples of when conduct and prudential issues come crashing together. And this is something that is recognized by regulators. And so from that angle, issues around governance, culture, and incentives are areas where both conduct and prudential regulators work together, because both of those have kind of outcomes for both a prudential and a conduct perspective. And this is something that the IAIS has been also focusing on with over the last few years through the work of the Governance Working Group, but also the Market Conducts Working Group. The IAIS has published a number of, I guess, features, including the ICPs and ComFrame text around corporate governance, board responsibilities, but also a number of application papers to support supervisors in grappling with supervising some of these elements. Now, as I mentioned, while I chair the governance working group within the IAIS, I come from the Prudential regulator, from the Bank of England. So I guess any conduct-specific elements, I will leave to Julien to answer. But what I will look to do is to pick up on 3 related features, which I think are quite key to helping get conduct issues right. The first, as you may not be surprised, is around governance. Having clear decision-making and a framework for clear decision-making is imperative. And this is the case for smaller firms, but also very much the case for large internationally active firms and the IAIS. The board is responsible for setting the strategy for the group or for the company that it oversees, and also agreeing the risk appetite. And through that, we expect board members, including very much the non-executive directors, to probe and ask around with difficult questions of how is it that a proposed strategy will be delivered? Is it realistic? What are the risks involved around that? What behaviors do these risks drive in order to achieve that strategy? And how do these risks sit inside the risk appetite that's been agreed? And it will be up to the senior management to deliver all of this, and it will need to be accountable and to have these discussions with the board so that it is comfortable on the direction of travel for the institution. Now, linked to having these good discussions at board with challenging questions and having clear decision-making, accountability becomes very important. And this is something that's been highlighted in a number of the IAIS documents. But also in the UK, some of you may be aware that we have the Senior Managers and Certification Regime, which was rolled out to insurers in December 2018. And this specifically targets with linking individual accountability with senior decision makers. And among other points, not only is intended to help firms hold the individuals accountable for their decisions and for their own the things they're responsible for, but also when things go wrong, say operational risk events, which includes events arising from conduct risk issues, we are then able to have conversations and ask pointed questions to the individual about what was it that happened in this place and what will be the mitigating factors for the next to ensure that this doesn't happen again. The second point, which is linked that I would like to touch on, is around culture. So I don't know how many times I've heard the phrase that culture is very hard and to not only quantify but also to think about it, and many find it quite a fluffy topic. But at the same time, it is very clear when you are operating in a toxic culture, and it is also very clear when things go wrong what the culture of that institution is like, and also how much it is costing the institution as well. And again, there the board has a very important role to play by setting the culture and the tone from the top, and for that to then be implemented across the organization at the senior management level, through to the middle management, through to the customer-facing staff, to ensure that you have that tone from the top going all the way through. And that is the case, again, for all insurers, and even for cross-border groups. This is something that has to work at both group level and the legal entity level, where local standards, rules, and local culture also have to be respected, and for this to be in line with it. And so there you would want the sort of top-down approach to meet the bottom-up approach when it comes to culture. And a key part of culture is having a diversity of thought, of experience, of skills, and to ensure that you do not have groupthink within institutions, among committees or among the decision makers across the entire cycle of a product, so that you do not have individuals just patting each other on the back and agreeing with each other constantly, but that you do have a good conversation so that a different assessment of what the potential risks might be. And then the third element that I would like to touch on, which is very much linked to culture, is incentives. So a culture will drive incentives among key staff, but also the way individuals are incentivized, and by that I mean particularly remunerated, that will drive the culture. That'll be a major driver of the culture. And so ensuring that the individuals are not, sort of key staff across the organization, are not purely incentivized by sales targets or profits will be a key element to contributing to policyholder protection.
Have touched on, apologies, old-fashioned as I said before. You have touched on a number of interesting topics, and before I give the floor to Julien, I would like to pose two questions to the other panelists based on what you have said. The first one has to do with the concept of risk appetite framework. In the UK, it's business as usual that conduct risk is part of that risk appetite framework in the same way that credit risk or market risk or concentration or whatever could be. You go to continental Europe, which is not so far away, it's not 12 hours like coming here from Madrid, and you ask senior management of a company or boards of a companies, why don't you have conduct risk as part of your risk appetite framework, as part of your ORSA? And they jump to you and say, because the day after I would have the regulator knocking at my door, forcing me to stop selling products. So Julien, what could you say about that? What would be your thoughts on reflections? Because the risk assessment framework is prudential, conduct is conduct. This is a clear link that we are exploring on this regard.
Yeah, well, first of all, I would like to thank the organizers for such a great panel, and very happy to be part of this distinguished group of people. And with the empty seats, I just hope that it's not the topic. It's because people are flying back, or the idea would be that we could have put ICS, culture, conduct, and governance, and maybe the room would have been more packed. But this being said, I think it's a great opportunity, and I just wanted to thank the IAIS for putting conduct on the panel, and hopefully with the new strategic plan, it's going to be ongoing for the coming years. The question you're raising is that I think it is important, and supervisors and insurers will be going there at one point. We're maybe a bit ahead of what I'm going to talk about with the linkages between the two frameworks for conduct of business and governance. But at the end of the day, I think that they need to be interlinked, and the question of including data or consumer data or policyholder customer data into an ORSA, it has to be taken into account by the insurers within their own risk management framework, because the risk is different. It's not a risk to the insurer. It's a risk that is faced by the customer, so it's something that's a bit different in the scope, and I will touch upon that in my 5 minutes of fame after that. So, but with regards to, I think jurisdictions are not at the same place. I know that back home in Canada, OSFI has created a new function for culture and conduct, and this will be addressed a little bit more at the provincial level. In Quebec, my hometown, my home province, it's something that is taken into consideration and has been taken into consideration for the last, I would say, 5 years or so.
Thank you very much. And Birny, one for you, because we were talking about incentives, and we have also been talking about culture. And Anna used a word which is probably very English, but it's extremely descriptive. Culture can be seen as fluffy. So as a consumer, where do you think that regulators and supervisors should be focusing? Such things as incentives, conflict of interest, or should they also be focusing on culture? Is there any benefit from that?
Well, as it turns out, I have an opinion on that. But first, I wanted to thank the IAIS for creating this session and for the opportunity to participate on the panel. We applaud the IAIS for the increased attention to the conduct of business, and I'm particularly thankful for the leadership that Anna and Julien have given to these issues. Thank you. In our view, the increased emphasis on conduct of business supervision is long overdue and necessary to bring a better balance of supervisory resources between prudential and conduct of business supervision. We're excited about the IAIS initiatives that Anna has discussed and Julien will discuss. but we would like to suggest that the direction of the activity be reversed. The IAIS approach appears to start with supervisor engagement on company culture, corporate governance, company risk management, based on the belief that there are a set of best practices in these areas, and if a company utilizes these best practices, good consumer outcomes or good conduct of business outcomes will follow. And we wanted to suggest that the approach should be reversed. We believe supervisors should be collecting and analyzing detailed data on actual consumer outcomes and utilizing the outcome analytics to assess whether the company has effective risk management and corporate governance in place. In fact, we believe the focus on corporate governance and company culture brings financial stability risks. If I can illustrate what I'm trying to say with a mental exercise, suppose that an insurer invented a new way to assess risk in life insurance and motor vehicle insurance. And in our example, the insurer has found a way to measure a consumer's level of stress and anxiety and to assess the consumer's state of mind. The insurer asserts that the consumer's state of mind is an excellent predictor of mortality risk and the likelihood of involvement in a motor vehicle accident. As supervisors, your first question is likely to be, what evidence do you have that your algorithm accurately predicts risk? The company responds that it has no evidence, but it's very confident that the algorithm is based on sound science and logic. As supervisors, you would likely be concerned about the introduction of an untested approach. If the insurance company is wrong about the accuracy of its algorithm, there is danger of prudential failure of the company as well as unfair discrimination against certain groups of consumers. Now consider a situation in which the supervisor requires all companies to use this algorithm. The concerns about company solvency and unfair discrimination would now become broader financial sector issues. If the algorithm is incorrect, then the insurance sector and financial system are now at risk. While this is an extreme example, it has relevance for thinking about supervisory efforts on governance and culture. While supervisors believe there are best practices in corporate governance and culture and risk management, and believe that companies that employ these best practices will produce financial stability and good consumer outcomes, the fact is there is little or no empirical evidence to support this belief. One reason is that there are very few company failures, so there are very few outcomes against which to calibrate the governance and culture guidelines. In contrast, there are millions of actual consumer outcomes every year, actual sales outcomes, actual claims outcomes. There's vast data available to analyze actual consumer market outcomes for companies and for the entire industry. This means that supervisors have the ability to identify those companies producing good consumer outcomes and those companies producing bad consumer outcomes. If a company is producing good consumer outcomes, it seems likely that the company employs good corporate governance and risk management. On the other hand, if the company produces poor consumer outcomes, it seems likely that the company's corporate culture, governance, and risk management policies and practices are lacking. In fact, there's ample evidence from the financial crisis and insurance industry scandals in the U.S. to demonstrate that the quality of consumer outcomes is an excellent predictor of the quality of company governance, culture, and risk management. So we appreciate the emphasis the IAIS is now emerging into on linking corporate governance, prudential supervision, and conduct of business, but we really believe that conduct of business should be informing the prudential supervisors in a big way.
That's very interesting. Maybe 2 points, and then we move into the next block. But I see Julien almost willing to jump like a tiger. So before my comments, let's see the tiger. Well, from Quebec, you don't have tigers, so probably it should be a bear or something like that. Please.
Frozen tiger. No, I think what Anna and Birny pointed out, and you need to understand they need to be interconnected. So conductive business and Prudential, and I think Birny's idea is interesting. We've always seen Prudential regulation or Prudential supervision feeding conductive business with governance. Frameworks, culture being embedded in the corporate governance framework. And so having conduct of business data or issues that can rise to Prudential, I think is interesting. But this being said, they need to be interconnected, they need to be dynamic. There is a mirror effect between those two types of supervision. I think Birny pointed that out. The poor management of Prudential risk could increase risk to unfair consumer treatment. And on the opposite, of course, persistent poor consumer outcomes could expose firms to prudential risks like reputational, regulatory, or legal. But once this is said, the thing is there's a difference in scope. When you look at prudential supervision, it is more means-based, so through processes and procedures, whereas conduct of business will also cover the risks. The Prudential will be focused on risks to the insurers and intermediaries, whereas conduct of business will also cover risks that are faced by customers. On the processes, Prudential is a bit more means-based. Conduct of business is outcomes-based. And one very important thing that comes out of ICP 19 and all of the work that Market Conduct Working Group has done in the last few years and is continuing to do is that the assessment has to be done through the whole life cycle of the product. So it's focused on the product, and then we start from product design and then through the whole thing until claims or the end of the life of the product. Another particularity of conduct of business supervision is because of asymmetry of information, you will find double proportionality principle. Proportionality for firms, everybody knows it, but on the conduct of business side, you also have proportionality on the customer. So retail customers will have to be treated differently than commercial ones. Another difference will be also maybe, and you talked, Birny touched based on this a bit, but the indicators used to identify risks can be the same sometimes, usually, but the outcomes could be different. An example will be high profit products. On the Prudential side, balance sheet, it's good, money comes in, it's fine. On the other hand, on the conduct of business, it could mean that it's a good product for the customer, but it could also mean that if there are high profits, it could be the incentives that kick in, it could be pressure to sell that product, so the conduct of business supervisor might look on this thing on under lens, I could say. And the use of more qualitative information also on conduct of business, which is, we all know, a challenge for senior management, board managers, and CCOs in particulars. A couple of minutes just on culture. ICP 19 is pretty, you'll find everything you need regarding conduct of business or fair treatment of customer culture. 19.2, the standard states that you need, or insurers and intermediaries need to have in their conduct or in their governance framework, fair treatment of customers, policies, and procedures. The drivers might be a bit different than the one on the Prudential side. There might be the same, but the outcome might be a bit different. And just one of them is the question of leadership. Of course, we all know the tone from the top is important, the middle management is important, but I would just like to highlight a couple, things that have been done in a few jurisdictions in the last year or so, or 2 years, UK, Hong Kong, Australia, is the question of what we call standards of accountability and conduct, and focusing on material risk personnel. So it's not only ICP 5 focuses on senior management, significant owners, but board members, but with this, you will focus a little bit more on middle or lower middle management, or anybody that would have a material impact on the outcome of the company. So head of agency and distribution, head of underwriting, head of marketing. So these ones are usually forgotten or not dealt with at the Prudential level, but a conduct of business side, if you want to implement a fair treatment of customer culture within the organization or the firm, this is an example that I think is very interesting and should be going forward. So, and we will address all this. We have addressed this at the market conduct level. A year and a half ago, published a paper on conduct of business risk and its management. You have in an annex more than a couple of dozens of indicators that can be useful for firms, conduct of business supervision, and we're working presently on a joint paper with governance, but I think we'll talk about that a bit later.
Definitely. People love spoilers. Two very quick comments. The first one is I want to put on the fridge an element that you brought in, which is the fact that indicators on high-profit products, for example, can be biased in the sense that they give us misleading information depending on how we take them. And I think this is something important to further elaborate and capture. The second one, and I think, Birny, you described it very eloquently, is that corporate governance, even culture, is a mean, it's not an end. It is a mean to make sure that you give a good outcome to your policyholder, and coming back to the letter of Larry thing, by so doing, like with any other business, ladies and gentlemen, a happy client is a client that provides a benefit to the company, which is a legitimate way to do. An unhappy client, or one which is kind of milked, then that's not sustainable. So we are also going to be bringing that element in, perhaps also in terms of maybe, Birny, I think we chat about that informally on a coffee break, but how supervisors are doing an approach to supervising this fluffy culture, using your words, is they are using the so-called smoking gun approach, which is they go to the outcomes that you were referring to. Take Australia, extremely high profitability, commissions over the ceiling, claims ratios which are a joke, etc., and they deconstruct, and through conduct, through governance, through the role of the boards, through the role of the risk committees and so on, identify what went fundamentally wrong to have, let's say, something too good to be true being part of day-to-day business. So may I, let's say, suggest that we move into the second block. We are getting closer to the 15-minute panic time, and then we will definitely touch on the policyholder protection dimension. But you were talking about the work of the IAIS. EIOPA did also an interesting piece of work in terms of conduct supervision, and they are bringing this concept of follow the money, which is also very much linked to what you are saying, Birny, or what you were saying. Very profitable products, little, if any, value to policyholders. The point that you were also indicating in terms of high profitability and so on. But at the same time, IAIS is working on drivers, both positive and negatives, to make sure that this element is properly captured. So I think this links extremely well on how this business dimension, which is an essential part of prudential supervision, because let's be very honest, if you want to supervise a company, you understand, or you need to understand how it makes money, and it makes money by selling products, and those products are the ones that may or may not have conduct risks. So, Julien, if I may come back to you again in terms of, okay, what are you doing in terms of drivers? How do you see this business reality? How do you recognize that it is legitimate to make some money if the product is good?
Thank you. I'll jump in. And so I think it's a given that companies are in business to not only serve customers, but to make money. If you're a shareholder-owned company, your primary obligation is to your shareholders. If you're a mutual company, your primary obligation is to your policyholders, but that means staying in business. So I guess the starting point from our perspective on identifying the linkages between prudential and conduct of business supervision is the data. Whether you want to take a follow the money approach, whether you want to take a corporate governance approach, you have to have data. You have to have data on consumer outcomes. Because anything that you want to do at some point in time has to be analyzed in terms of the outcomes you're trying to produce. So we think that there are some significant advances in this regard. I'd like to applaud the work that Julien and his colleagues in Canada are doing with their annual market conduct statement. It's analogous to the financial annual statement, but this annual market conduct statement generates significant data for supervisors to analyze and to assess conduct of business. In 1996, when I was at the Texas Department of Insurance, we developed a data collection program for market surveillance. This is over 2 decades ago, and we had a program to collect transaction data on every sale of auto and home insurance, every claim for auto and home insurance. That was 22 years ago. The technology, the data collection ability, the data processing ability is exponentially greater today to allow supervisors to collect that type of granular data and start doing the type of big data predictive analytics that industry is doing on all sorts of data. So my message is really quite simple. Whatever approach you want to take, you need some data to analyze in order to calibrate the tools that you're hoping to use.
Couldn't agree more, and let's also put this one on the fridge because it's something definitely worth developing also in terms of the new capacities that we do have. By the way, I do hope that it's not only the regulator, but any company has full data set in terms of this information because it affects business. But coming back to you, Julien, in terms of this business dimension and the work that you are doing, the work on drivers, could you please elaborate with us and share?
Yes, thank you. We just started working a joint work between Governance Working Group and Market Conduct Working Group. So it's at the very beginning, and you know, it's. I have the privilege of leading that work, being a member of both working groups. But what we're addressing principally is drivers of good and bad governance-related practices, behaviors towards customers. We like very long names, long titles for our papers, and they always finish shorter. But then again, it gives an idea as to what we want to work on. So, and what we, you know, the potential areas that we're looking at are corporate and risk culture that Anna covered, and then the conflicts of interest, but at a higher level. Not only the question of remuneration and incentives, which is very important, but also a question of conflict of interest, and I think Carlos raised it with the shareholders. How do you address, you know, or manage these conflicts of interest and everything that come or relates to intragroup also regarding cultures and drivers. So this, stay tuned. It will be in the works for the next few months, and we should have something by the end, I think, of this year, if I'm not mistaken. So this is a nice opportunity. So this is one item, and I think just coming back a minute or two on what Birny pointed out with regards to the use of data. Market Conduct issued a paper 1.5 years ago on digitalization and the what I would say the challenges for supervisors. And let's be honest, it's a challenge for regulators and supervisors to be able to analyze that data and making sure that the example you gave earlier in your opening remarks is something that is taken into consideration. We're working right now finalizing a paper on big data analytics, and I think one of the conclusions is that supervisors need to be more data-driven and to better understand the use of that data and what can come out of it, and you know, so to make sure that there are no poor outcomes for the customers.
Can you please maybe complement what has just been mentioned by Julien?
Sure. And just to briefly add, just to avoid getting many emails around Christmas of where is the paper. So it will be in the start of next year that it will be published, just in case everybody's hoping for Christmas reading now. And just to, I guess, touch on some of the points that have been mentioned, I think it's fair to say that prudential and conduct perspectives are this top-down and bottom-up. They're not mutually exclusive. They're very much reinforcing. So Birny mentioned that we spend quite a lot of time of developing best practices. Well, quite often what we focus on is the outcomes that we're trying to achieve or that we think would be the right outcomes and some ways of getting to those outcomes. There's, in the space of governance and culture, there's no one right answer. And there's no one size fits all, and that's something that we're very much aware of. So this is going to be something that fits with the institution, with their nature, scale, complexity, the type of business that they run, and also where they run it. And this is something that we're very mindful of. And in terms of what is it that we consider from the kind of prudential side, but also is of interest from a conduct side, is not only the design of the frameworks of which is important in itself, so all of the formal arrangements, and this is something the IAIS work has covered in the past, of not only making sure that you have the appropriate policies, delegation, responsibilities, that all of that is clearly set out, but it's also got to work in practice. So it's this design and the effectiveness angle and the behaviors of the boards, of the senior management. Are you getting the discussions across the product lifecycle? Is the customer, and again, whether that's the primary person buying that particular insurance product or whether it's the third party who then might benefit from that contract later on, how are they being considered throughout that? So what are the discussions that are being had throughout? And within the institutions, we would expect the data to be a big informant of that, of what is it that have we been doing right, or what is it that we've been doing wrong, and how does that affect our business models and how we approach things.
That's very interesting. And before jumping to Giovanni, there is, I think, the hot question when it comes to how to regulate conduct. There is an approach which is very principle-based. There is one which is quantitative hard indicators. 40% commissions is bad. 38, ergo, is good. You mentioned that one size doesn't fit all. You need to understand the reality. Is this kind of a message that the supervisory and regulatory community is less inclined on hard indicators and more inclined on a combination, a more holistic approach? That would be a spoiler.
So I can't speak for all supervisors, but I think there is judgment to be had in this case, and there will quite often be a sense of what is whether it's 38 or 40 whether that's the magic number. That's a tricky one, but depending on what the situation we're talking about. So to talk about incentives and remuneration, that there is a sense that a substantial proportion of, say, remuneration of material risk takers should be deferred over a longer period of time to avoid this sort of short-term sales-driven implications. So there will be an indication of what is the right proportion. In some cases, that might be driven by particular triggers or particular numbers, but I think there's not many cases where in the situation and the topic of culture, conduct, governance, and what we've been talking about, it's unlikely that there'll be one magic number.
Okay, I don't like magic numbers.
May I comment? So I think it's important to acknowledge how far supervisors have come in the last few years. 5 years ago, there was no conversation about market conduct or conduct of business informing prudential supervision. And today, we're not only talking about it, but there's active investigation and activity in that area. So there's been a tremendous amount of progress in our view. But there's a lot more that needs to be done. If you look at the resources that are still devoted to prudential supervision versus the resources devoted to conduct of business supervision, it's tremendously weighted towards prudential supervision. If you look at the data collection for prudential supervision versus the data collection for conduct of business supervision, again, tremendously weighted towards that. So as we move into this, we have to move beyond the acknowledgement of the role of conduct of business, but I think there's also a need to shift resources towards conduct of business, or add resources towards conduct of business. And the other part of it is that those resources may be different than what supervisors have at their disposal currently. In the U.S., conduct of business supervisors are predominantly auditors. They go in and examine companies and they audit what's happened. What's needed is to move from that auditing approach to an analytics approach. There's a need to employ people who know how to collect and analyze data and then act on those data in a very important way. So thanks for the progress to date, but there's still a lot of work to be done.
If I may, Carlos, just 1 minute, just to pick up on what Birny just said. Yes, within the supervisors, you're right, but also there's a shift that needs to be done within the firms. And one example are the CCOs, Chief Compliance Officers. You know, they usually are lawyers, and you know, they will come back and say, you know, how do I comply to these fair treatment of customer outcomes and fair treatment of customer culture? How do I assess it? And I think it picks up to what you say. There is a shift in the mindset, in the skill set also within the firms that need to become true. Because, you know, the CCO should be more involved upstream in product design, just to make sure that, you know, they don't wait until something comes up and then try to repair it instead of being preventive and proactive on this. So that's a small example, but I think that's one key person in control function that could make a difference on conduct of business.
If I could just follow up quickly on that important point. If conduct of business supervision is predominantly an auditing type of activity, then the company resources that are devoted to it will be folks who can respond to audits. If conduct of business supervision becomes more of an analytics type of thing that identifies issues, then the company's response to that will be more analytic responses to how do we address these problems as opposed to how do we fix what happened in the audit. So I appreciate the point you made. It's critically important.
It's an extremely valid one. But let me share an example of practical work with one of my clients. I sat with the compliance head, I sat with the heads of sales and myself. We took the portfolio of products and I asked them, let's do an exercise and quantify or identify product risky number 1, number 2, and number 3. The former regulator and consultant, the guy of sales, and the guy of compliance put the same 3 products on the list, which is also, I would say, signal of hope that we do know what we are doing or what we are not doing. I wanted to close with the third block, which is the consumer dimension. Prudential regulation has as main objective policyholder protection. In the good old days, it was only policyholder protection. Now you add financial stability, you add competitiveness, and conduct by definition, as you said, has to do with the outcome of for the policyholder. So that's clearly also an interesting link between the one side and the other. But my question to you, Birny, is from whom should we protect consumers?
I didn't quite get the question. From whom are we protecting consumers?
Yes, because they have to be protected. I think we all agree on that. That's why we're talking about policyholder protection. But from whom?
Well, it's from the consumer protection issues have to deal with the insurance products that are being sold to them and that consumers are buying. So unfortunately, there are some bad actors who are insurance companies. There are some bad actors who are insurance agents or brokers. So, and then they're bad products. So the consumer protection in that regard has to do not only with what those companies are doing, but what they're not doing, right? Because consumer protection not only involves the purchase of products and the use of those products, but there's also a consumer protection issue to being able to access products that are needed for financial security, for sustainability. So we also need to protect consumers from bad government policies that prevent companies from offering the products that are needed to consumers.
Let me be provocative. Should we protect consumers from themselves?
Absolutely.
I could agree. And I'm not going to mention my wife now because then she could kill me, and rightly so, if I may say.
But if I may just a second, you know, you talked about policyholder protection is a theme that we've used and used and used. Maybe we also need to change our mindset and maybe switch to fair treatment of customer. Maybe not protect them, but maybe treat them fairly. It's not just words, it's a concept, and this is where culture kicks in. So maybe it's a change of concept that we need now.
I think that's an extremely valid point. I've seen that the clock just tweaked into 0, but I also see that it is because it started at the official time and we started 10 minutes late. So with the indulgence of the IAIS, I would love to take at least 5 minutes for questions to you and for one question that links to yesterday. Yesterday there was a ranking in terms of relevance and emerging risks, and you had number 1, fintech. Number 2, cyber risk. Number 3, sustainability. Number 5, demographics. So you know I have 5 children, so 2 or 3 like myself, there is not such an issue there. Number 4, conduct risk and consumer protection. Now, let me tell you something very quickly that the regulator has done in the UK. Long-standing clients. Long story short, they have identified that in particular in PM and C insurance, motor insurance and so on, the way to subsidize new portfolio was with the existing one. So myself, a good client, 10 years with the company, was paying 20-25% more than a new client. And they said, this is unacceptable. Now, if I think about it, yes, it's conduct, but it's fundamentally changing the way we have been doing business for the last 25 years. With this example in mind, if you would have to vote again, would you still be putting cyber risk or sustainability on top of conduct in terms of priorities going forward? And if they do so, are they doing it right, Birny? Are they doing it right, Julien? Are they doing it right, Anna?
Is who doing it right?
Our audience that yesterday said that it was only priority number 4 or number 5 moving forward.
Well, one of the things that you learn when you start investigating the big data and algorithms is that your source of data can reflect and perpetuate a particular bias. So our audience of esteemed industry and supervisors is biased. Where we do have 200 consumer stakeholders in the room, I think we would have gotten a different outcome. But the fact of the matter is that those issues are all very important. From a consumer perspective, from a supervisor's perspective, and a company's perspective. I don't see how you could prioritize something as more important than cybersecurity. You can certainly say conduct of business is as important, but cybersecurity and financial stability, those all go hand in hand with not only fair treatment of consumers, but sustainability and resilience. So I don't think it's an either or. I don't even think it's a prioritization. I think these are things we have to tackle simultaneously.
Okay.
I guess just to pick up on one of the sentences that was made earlier regarding sustainability of it's hard to operate a business in a dead world. Well, it's harder to protect consumers in a dead firm. Some of the risks and areas that were highlighted in terms of helping ensure the sustainability of the firms themselves as well, given the risks that they're facing from cyber, from fintech, etc. This is very much supports, and the way you look at it from a Prudential lens, the policyholder protection, so that the insurers are still there to support their customers.
That's an extremely valid point. A closing remark from you, and then 2 questions maximum from the audience.
Well, just to answer your question, I think, it's if it's because the audience felt that it was not an emerging risk or new risk, then kudos. If it's number 4, I'm fine with that. So if people think that they understand it, if it's not an emerging risk, I think it's good news.
Very true.
I was just going to ask if we have time for an audience question or 2.
Yes. 2 questions, hopefully, but now I'm basically abusing of the hospitality of both Buenos Aires and IAIS. Okay, then I leave you with an open question to close up and with a request. The open question is why when I speak to industry, everybody wants to be second mover in terms of change? And the request is please join me in a big applause to our panelists because they have done an amazing job. Thank you.